They turned mortgages into gambling chips, bet the entire economy on a math formula nobody understood, and when it exploded, taxpayers bailed them out with trillions while millions lost their homes. Then the banks that caused it got bigger, the executives kept their bonuses, and almost nobody went to jail. This is the story of 2008. The year the financial system collapsed, took the world economy with it, and somehow convinced us it was too important to punish. And the strangest part? We didn't demand justice. We wrote the check. Before the collapse, there was a simple idea that seemed bulletproof. Houses always go up in value. Always. For decades, that's what America believed. Your home wasn't just shelter, it was your ticket to wealth. And Wall Street was watching. In the early 2000s, interest rates dropped to almost nothing. Banks had piles of cash and nowhere profitable to put it. Then someone noticed mortgages. Boring, steady mortgages. Families paid them every month for 30 years. That's predictable income. That's valuable. But there weren't enough borrowers. At least not enough good ones. People with solid jobs were already buying houses. The safe customers were tapped out, so the banks made a decision that would break everything. If we can't find better borrowers, let's lower our standards. They called them subprime mortgages, loans given to people who probably couldn't pay them back. No job verification, no down payment. Bad credit? No problem. They were called liar loans, because everyone knew people were lying, and nobody cared. A waitress making $30,000 a year got approved for a $700,000 house. Mortgage brokers weren't paid to care if you could afford it. They were paid to close deals. More loans meant more commissions. So they sold. Hard. Adjustable rate mortgages became the weapon of choice. Low payments for the first 2 years, then they'd skyrocket. But brokers had a script for that concern. Don't worry about the future payment. In 2 years, your house will be worth more. Just refinance. You'll be fine. And people believed it, because houses always go up. Everyone said so. Meanwhile, the banks weren't keeping these sketchy loans. They were selling them. This is where it gets clever. Wall Street had invented a machine to transform garbage into gold, at least on paper. Here's how it worked. A bank gives out 1,000 mortgages. Good ones. Bad ones. Terrible ones. Then they bundle them all together into something called a mortgage-backed security. It's like a box of mixed chocolates. Some are great, some are awful, but you're selling the whole box at once. Then they'd slice these boxes into different levels. The top slice got paid first and was called AAA, super safe. The bottom slice got paid last and was risky. But here's the trick. Even though the box was full of garbage loans, the math said the top slice was still safe. Rating agencies like Moody's and Standard & Poor's were supposed to check this. AAA meant safe as government bonds. But the rating agencies had a problem. They were paid by the banks creating these things. The same banks who wanted good ratings. See the conflict? So they gave AAA ratings to boxes stuffed with liar loans. Pension funds bought them. Insurance companies bought them. Foreign governments bought them. Because AAA meant safe, and everyone trusted the rating. But Wall Street wasn't done. They took the risky bottom slices that were hard to sell and bundled those together into new securities. Garbage squared. Then they got those rated AAA too. More sales. The machine was printing money. Banks were so confident they started buying these securities themselves, making huge bets with borrowed money. 30-to-1 leverage meant for every dollar they had, they borrowed 30 more. Massive profits if things went up. Total destruction if things went down. And then came the insurance. Credit default swaps. Basically bets on whether these securities would fail. But here's the insane part. You didn't need to own the security to bet against it. It's like buying fire insurance on your neighbor's house, then betting it burns down. AIG, a massive insurance company, sold these bets to everyone. They collected premiums and promised to pay out if mortgages failed. But they never set aside money to actually pay. Why would they? Houses always go up. The whole system was a tower. Mortgages at the bottom, securities in the middle, bets on top of bets at the top. And every level depended on one thing. Housing prices keep rising, but towers built on assumptions fall hard. The cracks started small. In 2006, housing prices stopped climbing. Then they dipped. Suddenly, those adjustable mortgages reset. Payments doubled, tripled. Families couldn't pay. They called their banks to refinance like they were told. But refinancing required home values going up. They weren't anymore. Foreclosures started. A few at first, then a flood. Empty houses hit the market. Prices dropped, which caused more foreclosures. The cycle fed itself. Now here's where the house of cards collapsed. Remember those securities rated AAA? They were filled with these failing mortgages. As defaults spread, the securities lost value. Fast. But nobody knew which ones were infected. They were so complicated that even the banks couldn't figure out what they owned. Trust evaporated overnight. Banks stopped lending to each other. If you don't know if the bank next to you is holding a ticking bomb, you don't lend them money. Credit froze. And modern economies run on credit. Bear Stearns went first. A giant investment bank, 85 years old, collapsed in days. March 2008. The government helped arrange it. Don't panic, they said. This is contained. It wasn't contained. Lehman Brothers came next. September 2008. Another giant, 158 years old. The government decided to let it fail. Teach the market a lesson about risk. The lesson worked too well. Lehman's bankruptcy triggered chaos. Credit markets seized. The stock market crashed. Companies couldn't borrow money to make payroll. The entire system was hours from complete meltdown. This wasn't a Wall Street problem anymore. This was everyone's problem. AIG was next. Remember them? The ones who sold all that mortgage insurance? They owed hundreds of billions they didn't have. If AIG failed, every bank they'd insured would collapse. So the government stepped in, $85 billion, then more. The bailouts came fast and enormous, $700 billion approved by Congress. TARP, they called it. The biggest banks got cash. Just cash. Keep operating, keep the system alive. Citigroup got $45 billion. Bank of America got $45 billion. Goldman Sachs, Morgan Stanley, Wells Fargo all got billions. The message was clear. You're too big to fail. Your mistakes are too expensive to punish. Meanwhile, regular people got destroyed. 9 million families lost their homes. Retirement accounts cut in half. Unemployment hit 10%. $27 trillion in household wealth vanished. But the banks survived. The executives kept their jobs. Many kept their bonuses. Some argued the bailouts prevented a depression. Maybe they did. But here's what didn't happen. Accountability. Out of thousands of executives at the banks that caused this, guess how many went to jail? 1. A single mid-level guy. Not the CEOs, not the traders, not the people who knew they were selling garbage. The rating agencies that stamped AAA on junk? No charges. The mortgage brokers who lied? No consequences. The banks that bet against their own customers? Fines. Just fines. And the rules that were supposed to prevent this from happening again? Watered down, delayed, fought at every turn by bank lobbyists. Some regulations passed. But the banks that were too big to fail in 2008, they got bigger, way bigger. The financial system learned a lesson, just not the one we hoped. They learned that if you're big enough, reckless enough, and connected enough, the taxpayers will catch you when you fall. Risk is profitable. Consequences are optional. Maybe that's the real story. Not just about mortgages or complex financial products, but about a system that privatized the profits and socialized the losses, where the people who gambled walked away richer, and the people who played by the rules paid the bill. And that's how 2008 didn't just crash the economy. It revealed a truth. When the powerful fail, they get rescued. When the powerless fail, they get foreclosed. Every time. And if this story made you angry, good. Because the most dangerous crashes aren't the ones caused by bad luck. They're the ones caused by greed that went unchecked and crimes that went unpunished. If you want more stories like this, stories that break down money, power, and the systems that shape our lives, subscribe. Because the more you understand how these machines work, the harder it is to get crushed by them. And remember, when the system tells you something is too big to fail, ask yourself who profits from that being true. Because usually it's not you.